This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
The question this time is the question Prodigal. It's from June 2011. It's question 1. Look at the question. Required, statement of income. Prepare the equity section of the consolidated statement. You're not required to calculate consolidated goodwill. You're not required to calculate consolidated goodwill. All right. Or produce the statement of changes in equity. Okay. So it's just the equity section, including the NCI. That must mean that if there is any impairment of goodwill, it must be given to us. And there's a Part B for 4 marks. IFRS business combination permits a non-controlling interest at to be valued by one of 2 methods, either at proportionate share or at fair value, usually determined by the directors. Explain the difference that the accounting treatment can have on the consolidated financial statements, including where consolidated goodwill may be impaired. All right, well, let me say what my local students here would likely do, despite the fact I stand and shout at them and jump on the table. My local students here would instantly get into the figures and probably would therefore, at the end of 45 minutes, not get anywhere near Part B. And I think Part B, if you look at it, Part B should be straightforward 4 marks. There's actually 2 different questions there in Part B. Explain the difference that the accounting treatment of these 2 methods can have, including where consolidated goodwill may be impaired. So we've got the different impairment of goodwill treatments for 1 mark each, and the explanation of the difference for 1 mark each. So that's what I'm going to be doing first. I'm going to be looking at Part B. Now 4 marks, 1.8 per mark is, a quick way of doing it is 4 times 2 is 8 and take off 10%, so it's 7.2 minutes is the time available for Part B. 4 marks, another bit of time allocation, is 4 divided by 2 is 2 minutes, and that should be planning time, and that's what I'm going to do. I'm going to plan in extended format. I'm going to plan 4 things to say. I'm not going to write them out. Apart from anything else, it's difficult to write on the screen. It's like trying to write on a piece of glass. So I'm going to spend just 2 minutes thinking of 4 things to say. So on a proportional basis, only goodwill attributable to parent is shown, and therefore NCI is, I'm going to say arguably, understated, undervalued, and the consolidated statement of financial position does not include all assets, because the sum goodwill probably attributable to the NCI, and therefore it's inconsistent. All other assets and liabilities are shown in full. Value on fair basis, on fair value basis, resolves this problem, this issue. It's new under IFRS 3 revised. It addressed this anomaly, this inconsistency, and now shows either subsidiary assets in full, that's the new method, or allows a continuation. This is much too much for 2 marks. Allows a continuation of the old method, i.e. on a proportional basis. That's much too wordy. Impairment, if we're not giving the NCI any goodwill, that's the proportionate method, then any impairment must be entirely attributable to us. If valuing NCI on a full fair value basis, then any impairment needs to be prorated between us and the NCI. Okay, that's the basis of what I would write. I would write it a lot neater. I do apologise, but I have read out for you as I've written it. I've read out every word that I've written, so you can't really complain about. I can't read it. I've been speaking it aloud for you. If it were me in an exam room and I had a piece of paper and a black biro in front of me, then it would have been legible. But you've got the benefit of listening to me. The time now is 16:46. That's 7 minutes I've taken, and I should have taken 7.2 in total, but I've been speaking it, I've been writing it slower, but that's what, and certainly I've written it in much more fully than I should have written a plan, much fuller than a plan should be. A plan should just be bullet points enough. That would be half a line for a bullet point should be enough for a plan. Okay, so 7.2 minutes. Well, what I've now got is I've got 21 marks to do, and 21 marks is 42 minus 4.2 is 37.8 minutes. 0.8 is 48 seconds. 38, so it's 16:47, and I'm going to take 38 minutes. So 17:25 is my stop time. Alright, 17:25 should be where I finish. So here we go with Prodigal. We've got to do the statement of comprehensive income for the year ending March 11 and prepare the equity section, including that of the non-controlling interest. Okay. Working one, Prodigal. I can see there's no associate, so it's just Prodigal and Sentinel, and the top line tells me I buy 75%, so 25% is for the NCI. The only thing I've got to check is the dates. This is the 1st of October, and we're running through, it's another mid-year acquisition. October, November, December, January, February, March, 6 months pre, 6 months post. Do that on your fingers, please. He's started not messing with your head, but is sometimes 4/8, sometimes 5/7 or 7/5. So just calculate the time periods pre and post acquisition. Calculate them on your fingers. You can't see me do it on my fingers, but just doing it down here, October, November, December, January, February, March, you can see that effectively I'm doing it on my fingers. It's a share-for-share exchange, 2 in us for 3 in them. So working 2, although we're told we don't need to calculate this, I do need... Is there a goodwill impairment? It's not suffered any impairment. All right, so I'll do the goodwill. This is not needed. It says not needed in the question. I'll do it anyway so that we can see how the basis of goodwill is calculated. It's 75% of the shares, which is 160,000. They're $1 shares, so 75% of 160,000. For every 3, we issue 2. Do we have a value for our shares? Yes, we do. In the opening paragraph, it's $4 a share. You see, we do need this because we've got to work out the shares that we're issuing. Have we recorded this? No, you see, look at that. Halfway down the question, just immediately below total comprehensive income total, it says the following information for the equity of the companies as at 1st of April 2010, so at the start of the year, before the share exchange took place. So we do need this. I say we do need this line because it tells us how many shares we issue, and it also tells me what the share premium is going to be. 75% of 160,000 is 120. 120 divided by 3 is 40. 40 times 2 is 80. 80 times 4 is 320. So we've got $320, $1 million. But the number of shares, that's 120 divided by 3, 40, is 80,000 shares issued at a premium of $3. That's 240,000 premium and 80,000 share issue. So we do need that because that's part and parcel of the equity section. The equity section, we don't need the statement of changes in equity, but we do need that information for the equity section. Fair value. Oh, anything else? Or was that it? No, that was it, wasn't it? It's just that. Or the NCI. NCI, don't forget the NCI. NCI is 25% of 160,000, which is 40,000, and the value of Sentinel shares, the value of the Sentinel shares. Do we know that? Oh no, it doesn't need it. It just tells us in point number 4. It says the value of the NCI is 100 million. That gives me 420 for the value of the company. Now I need that as well because the NCI, we're going to have to work out what the NCI is. So not for the statement of changes, but for the fact that it's the equity section. Now I need to look at fair value. This is not needed. Fair value of net assets at date of acquisition. This is extra just for your sakes. The shares are 160. The premium, nil. This is as at date of acquisition. Revaluation, nil. Other equity. The other equity is 2. Retained earnings brought forward. Well, we're given the figure of 125. And retained earnings for, is it 6 months, isn't it? Yeah, 6 months. Retained earnings for 6 months of this year is 33. Half of the profit for the year, 33. And that gives me then to 310, 320.2. Compared with 420, that's 99.8 is the goodwill. And we don't need that. It actually tells us we don't need that figure. Do not calculate goodwill. So anything from there downwards is unnecessary. You do not need that. That was me doing it for your benefit. If you had been asked to calculate goodwill, then there it is. Okay, point number 1, paragraph 1. The policy is to revalue group's land to market value at the end of each accounting period. Prior to acquisition, Sentinel's land had been valued at historic cost. During the post-acquisition period, the land had increased in value by 1 million. So we've got an increase. I'm going to put that in 1 million increase in Sentinel land. But it has recognized the revaluation. Look at that, the last sentence in point number 1. Sentinel has recognized the revaluation. So that's not needed. That's already included. There it is. It's in the other comprehensive income. Other comprehensive gain on revaluation of land. And this is post-acquisition, so that would needs to be consolidated. Point number 2. Immediately after the acquisition, Prodigal transferred an item of plant with a carrying amount of 4. Okay. Prodigal to Sentinel. It had a carrying amount of 4 at an agreed value, so it went from 4 to 5, so we got 1 million, which is unrealised profit. At this date, the plant had a remaining life of 2.5 years. So that's 2.5 years, that's 400,000 per annum depreciation on this 1 million. And we're working into 6 months because we're only looking at a 6-month period, 6 months post. So it's 200 depreciation in the post-act period. Now, pay attention because this is the first time I've ever said this. What I have normally done, that's 200,000 on that 1 million, and it shouldn't be 2.5. That's depreciation is 1 million. Depreciation there is 800,000. So we've got a 200,000 depreciation. Now this is the first time I've ever done this because it was brought to my attention just yesterday that in fact the treatment now should no longer be in the seller's books. This should no longer happen. Reduced by 1 million TNCA and reduced by 1 million the revenue retained earnings. And now I'm only writing this to tell you that this is wrong. In the buyer's books, I need to increase retained earnings by the depreciation by 200 and increase TNCA by 200. This is incorrect. All right? With effect from just recently, it's just the net adjustment, which is 1 million decrease and 200 increase. The net adjustment of 800,000 is the adjustment to make, and the adjustment is to reduce TNCA by 800 and reduce retained earnings by 800 in the seller's records. Now, the rationale, I've for years and years and years, ever since I taught consolidations, the rationale is quite sensible in my mind that this is an unrealized profit and this is depreciation charged on an unrealized profit. But apparently the rationale now is that as each year goes by, or as each subsequent post-acquisition period goes by, this profit is actually being recognized, and it's being recognized by way of use in the post-acquisition period. So the 200 depreciation is in fact 200 of that million, and it is now recognized because the 6-month period has elapsed since the transfer. Previously, what I have said is in the seller and in the buyer, In the seller, I've reduced retained earnings, reduced TNCA. In the buyer, I've increased retained earnings and increased TNCA. This is now no longer acceptable. For this, I apologise. The course notes are therefore needing now to be amended. The figure is now a net adjustment in the seller, and there's no adjustment in the buyer. Okay, so looking at this one then, we've got a net adjustment of 800,000. And the seller, who is it doing the selling? Prodigal. We need to decrease TNCA by 1 million minus 200,000. And we need to decrease Prodigal's retained earnings by 800,000. Okay, that's paragraph 2. And it's part of cost of sales. And the remaining life of 2.5 years, Prodigal had included the profit on its transfer as a reduction in its depreciation costs. Well, now there's something definitely wrong there. As a reduction in its depreciation costs. No, I'm not happy with the treatment of it. It shouldn't have been used as a reduction in the depreciation costs. Just let me read it again. At this date, the plant had a remaining life of 2.5 years. Prodigal has included the profit on the transfer, so it's an 800 adjustment, and we need to add it to cost of sales. Yep, which is there. So increased cost of sales, therefore reduce the profit. Okay. Point number 3. After the acquisition, Sentinel says S to P, it's a PUP calculation. It will be there. There are always a PUP calculation in these questions. Which sold goods to Prodigal for 40. I'm just going to write that in before I forget it. I'm just going to write in against cost of sales on the question paper. I'm going to write minus 40. And against revenue, minus 40. These had cost Sentinel 30, so it's 30 plus the 10 profit is the 40. 12 of that 40, which is what, 30%, isn't it? So 12 of the 40 is still in stock, therefore 3 profit, which is a quarter profit. 3 is the PUP. And that needs to increase cost of sales and decrease inventory on the statement of financial position. And again, I'm just going to write that into my question. I've got to increase cost of sales by, what is it, by 3, and decrease inventory. But I'm not asked to do, I'm not asked to do a balance sheet, am I? No. Okay, so increase cost of sales by 3. Point number 4, values non-convertible, we dealt with that. Point number 5, that dealt with. Point number 6, dealt with. Point number 7, there is no point number 7, that's it. What are we doing? Prepare consolidated statements of comprehensive income and the equity section. Okay. Statement of comprehensive income. Revenue. Don't forget we have to time a portion. So its revenue is 450 plus, it's 6 months, isn't it? Yeah, 6 months. Plus a half of 240. Okay. But then there's also the intergroup. I've written that into my question, minus the 40. So 450 plus 120 is 570. 570 is 530. Is the revenue. Cost of sales is same principles, 260 plus a half of 110, that's 55, minus the 40 cancellation, that 40. Then I've got to add the PUP. The PUP is in S, and the PUP was 3. And I've also got to make an adjustment for the unrealized profit on the plant. So plus 1,000, or 1,000,000, isn't it? Plus 1,000,000 minus 200,000. Yeah, I think so. 240 plus 50 is 295, 255, 258, 259. Is it 258,800? Is that right? 258,800? 240 plus 55 is 260. Where have I got 240 from? 260. That's 278. Let's try that. 260 plus 55 is 315. Minus 40 is 275. 278, 279, 278,800. Yep. 251,200. I think. Please, as usual, check my calcs. Distribution costs. 23.6 and a half of 12 is 29.6. Admin expenses, 27 plus a half of 23. I don't know if you heard that, but that was my stomach rumbling. I'm ready for dinner. 11.5, that's 38.5. Are there any? Yes, there are finance costs. Finance costs of 1.5 plus a half of 1.2, that's 2.1. Don't think, I've not written anything in my question papers. I'm now just going to have to go just skittle through the question. I don't think I've forgotten anything, but I'll just read through the question very quickly. No, I don't think so. So that's 40, 50, 69, 70,002, 181. Does that sound right to you? 181. Tax, that's PBT. Tax is 48 and a half of 27.8. That's 13,961.9. That's 119,001. That's the profit that's profit after tax. But then we've got the other comprehensive income. We've got the gain on land revaluation. And the gain on the land revaluation is 2.5 plus land revaluation. Paragraph 1. During the post-acquisition period, so it's entirely post-ac. So 3.5 is gain on land revaluation, and we've got the loss on fair value of the equity instrument, of the financial instrument. And the loss on the fair value, that's 700. What about this for the subsidiary? What does it say? Where does it say? Does it? Doesn't actually mention that loss on the fair value for Sentinel. So I'm going to assume that accrues evenly. It does say, doesn't it? All items in the above statements of comprehensive income need to accrue evenly, unless otherwise stated. So I'm plus a half of 400. I'm going to put that in 900. That's a loss. So that's a 121,007. Should be the total comprehensive income, total profit and comprehensive income. And the question says, what am I meant to be doing? It says, prepare the consolidated statement, which I've done. Now prepare the equity section of the balance sheet. So shares, doesn't want anything else, just wants the equity section. Shares, where are we? Up here, we needed 80,000 shares added at a premium of 240. So 80,000 shares. The equity section. We started off with 250 plus the 80 gives me 330. Premium, we've just worked out, is 240. We started with 100 plus 240 is 340. Okay, then we've got the revaluation reserve. And the revaluation reserve, that's us, that's 8.4. And it has already, hasn't it? Has it already been reflected? Revaluation. Prodigal had a revaluation prior to its acquisition had been valued at historic cost. During the post-acquisition period, Sentinel's land had increased by 1,000. Okay. And we've got our own. Yeah, the 8,400 is brought forward. We've got 2,500 of our own, and we've got 1 million of the subsidiary. But it's only our share of that 1 million. So times point, what's our share? I'm going to look at the question. 75%. 75%. So 10, 9, 11, 650. That's the revaluation. Other equity is 3,002. That's our own. 2,002 was the brought forward of the subsidiary. The loss for us is 700. And there's a loss for the subsidiary, which we've actually already worked out, haven't we? It's 200, but our share of that 200 is 75%. So that's 150, 850. 850 coming off that is 2,350, isn't it? I think it's 2,350. And retained earnings and NCI, I would sensibly, and I'd have sensibly done that. The profit for the year is 119.1. But that includes the NCI, and we've also got the brought forward retained earnings of 90. But I now need to work out what is the NCI's interest in that 119.1. Have I already done that? I don't think I have I? No, I've not done that. Okay, it's actually working 4B, isn't it? The NCI interest in the profits for the subsidiaries year. The 66,000 is the profit for the year, but it's time apportioned, so divide by 2, that's 33,000. But we've got to take off that the adjustments. Have I written any adjustments down? Immediately after the acquisition of Sentinel, the Prodigal transferred an item of plant, so there's no adjustment there. After the Sentinel sold, so they've got PUP of 3 million. That gives me 30 million. NCIs are goodwill is that and the stamps are deemed evenly over the period. So the NCI, their share is 30,000 profits times 25% is 7,500. So that's their share of this figure, of this amount. 7,500 is attributable. Of this figure, 121, well, they're interested in that 1,000 and that 400, that 200, aren't they? So 1,000 and minus 200 is 800. 25% of 800 is 200, so they need an additional, so that's got to be 7,700. So they're interested in the 1,000. They're interested in 200 loss, So 800, their share of that 800 is 25%, which is 200. They've already got 7,500 up there, so their interest is 7,700 in these profits. And the equity section then, the 7,700 is what they're interested in. Value at date of acquisition is there, 100,000, plus the 7,700 gives me 107,700. And that should be, I'm thinking, that should be their share of the 107,007. This one, retained earnings, minus then the NCI, 7.5. So 119, 209.1 minus the 7.5 is 201.6. And the equity section is therefore 300. 2, 3, 4, 5, 6, 13, carry 1, 8, 9, 3, 6, 7, 8, 9, 993, 300, I think, is the equity section. And that's the answer to part B. No, is it part B? Part A too, isn't it? Right, and the time is 17:15. What time did I say I had to finish? No, 17:25 was my finish time. So 17:15, I'm 10 minutes ahead. It's an awkward one. It's awkward because some of the adjustments have been. Paragraph 1, the last sentence in paragraph 1, Sentinel has recognised the revaluation within its own financial statements. Now, Prodigal has not reflected the acquisition within the figures that he's given us, the 1st of April figures that he's given us. There's time apportionment all the way through of the Sentinel to think about, and some of it is not completely evenly time apportioned, like, for instance, the gain on the revaluation of the land for the subsidiary is entirely post-acquisition. So yeah, it's a tricky question, that one. But I keep saying it's doable. There are marks available. There are marks for picking it up. That's obviously crucial. It's a key element. The goodwill we do need, because we need to know how many shares are being issued and the premium that they're being issued for. The NCI, the value at the date of acquisition, we need that for working for A to tell me what the NCI share is on the equity section. We don't need any of this. Don't need any of that. It's all superfluous. This increase in Sentinel land has already been accounted for. This is interesting. I'm still not happy with it. This is what we now have to do, whereas previously we would adjust $1 million there, and we would adjust for the excess depreciation there. I will give credit to a student on Open Tuition, Hilarious Astal, very kindly brought this to my attention. So I'll give him credit for bringing it to my attention, the fact that it is now, and I don't know whether it's a requirement that it should be done this way, or whether it's acceptable that it should be done this way, but I've the feeling it's a requirement that we should now just show the net adjustment rather than the two separate ones. This is what the correct treatment is, and it's always in the seller's books. PUP is as normal. There's nothing new there. It's worth a couple of marks. 3 million. It's 10/40. That's that was the profit figure on the deal, and 12 of them are left. It's a quarter of the selling price. Quarter of the transfer price is the PUP. And then that's worth a mark, that cancellation. That's worth a mark, adding back the PUP. this is worth the mark, this is the profit has been used to reduce, and it shouldn't have been because it's an intercrop profit. That's worth the mark, the time apportionment of the subsidiary, and then it's the time apportionment all the way down. No, now this is interesting because some of the bigger tuition establishments say write out your pro forma first and put in the easy figures. I genuinely do not believe, apart from time apportionment, I can't see that these figures are worth anything. And I believe that your marks are in these workings. That's where they are. That's why your workings have to be neat and logical and sensible and understandable, clear. So that's why I write these things out. 700.5 or 400. That's why I write 100 plus 240, 8.4 plus 2.5 plus 1 times 7.75%. That's why I do it.